Hello everyone. In this presentation, I will be discussing another case study on hedging strategies using futures. I will discuss hedging and competition, where I have taken the example of jewelry making industry. We all know that there is large competitive pressure within the jewelry industry. The price of a jewelry produced by a firm in the industry may fluctuate due to the change in the price of raw material, that is gold, or interest cost, and so on. So here in this example we are taking two firms, PC Jeweler and Tanish. We assume that PC Jeweler do not hedge against the movement of the price of the gold, while Tanish uses future contract to hedge its purchase of gold. So we will see how does hedging affect the profit margin of Tanish and how hedging protects Tanish against the gold price fluctuation. So this is our case study 5 of our topic hedging strategies using future, and now we will find out, is hedging profitable? Here we have taken two manufacturers of gold jewelry to find out the impact of hedging and competition between the two. So one is PC Jeweler and another one is Tanish. We assume that PC Jeweler does not hedge against the movement of price of gold, whereas Tanish use future contract by taking a long hedge position to hedge its purchase of gold. Now we will see how hedging of gold would help Tanish in production of jewelry and how does hedging affect the profit margin of Tanish. At the same time, we will also try to find out what would be the effect on profit of PC Jeweler if it does not opt for hedging and buy gold at the spot price to produce the jewelry. So let's find it out. Profit of the manufacturer of gold jewelry depends upon the price of gold which is used for making gold jewelry. Now the question is, why gold price fluctuates? The price of a gold fluctuates because of many reasons. It can be because of the demand and supply mismatch. As the supply of gold is very less, it's a natural resource and available very limited place, but there's a huge demand for gold. Might be because of the change in the government policies. Government might take a decision to buy or sell gold through RBI, or due to the change in import duty, change in investment trend, huge inflation, gold is considered a safe haven, change in the interest rate. If the interest rate falls in the bank, people try to invest in yellow metal, that is gold, to get high returns, and currency fluctuation. That is, gold is traded in global currency with US dollar. So any change in currencies lead to fluctuation in gold price. So there are various reasons which affect the price of gold. So if there is a change in the price of gold, there will be a change in the price of gold jewelry, and that would affect the profit of the gold jewelry manufacturer. In this case study, Tanishq has opted for long hedge. Long hedge involves taking a long position or a buying position in future contract. Now the important question that comes here is, when is long hedge appropriate? Long hedge means taking a buying position. So long hedge is appropriate when a company or a manufacturer knows it will have to purchase certain assets in future and wants to lock in price now. This would help the manufacturer to move from uncertainty to certainty with respect to price and other market conditions. PC Jeweler and Tanishq both require gold for the production of gold jewelry. As per our assumption, PC Jeweler does not opt for hedging. It purchases gold for the manufacture of gold jewelry from the current market price or the spot price, whereas Tanish opt for long future contract. It take a long position or a buying position in a future market to hedge the price of gold for the next 1 year. The objective is to protect itself from the fluctuations in the price of gold and neutralizes its position by opting a long future contract in the derivative market. Let's take a timeline. We are standing in June 2019. The spot price or the current market price of 24 karat gold for 10 gram is 35,220 rupees. Now, Tanish decided to go for a long hedge to purchase gold for 1 year. That means it decided to opt for hedging for June 2020. Now, hedging price would be decided on the basis of the historical price. We can see from the chart that the price of 24 karat gold or 10 grams fluctuating between 1,000 to 3,780 rupees. So on the basis of the past price movement, Tanish decided to hedge its future price of gold. That is lock-in price which Tanish decided to pay in June 2020 is 40,000 rupees for 10 grams of gold. Now, what will happen in June 2020 with the price of a gold is completely uncertain. Either the price would go up or the price would come down. But the price at which Tanish will buy the gold is now locked, or that is the future price is now promised by Tanish that it would pay 40,000 rupees for 10 grams of gold. Now in June 2020, many economic situation changes, the outbreak of corona, huge inflation, the price of a gold increased to 48,000. That is the rise of 13,000 rupees per 10 grams. So the spot price of a gold in June 2020 increased by 13,000 rupees per 10 grams. That is 48,000 rupees. So if Tanish has not entered into the long future contract, Tanish would have to buy the gold at a current spot price. But since it has already purchased gold in the future market, it has to pay the gold as per the lock-in price or the future price it promised, that is 40,000. Whereas for PC jeweler, it has to pay the spot price to buy gold for making jewelry because PC jeweler has not hedged its position with respect to gold price. So in this future contract, Tanish opted for long hedge. The underlying asset is gold. Quantity promised is 200 kg to buy. Quality to buy is 24 karat. Future price or lock-in price or the hedging price is 40,000 rupees per 10 grams and the expiry is June 2020. So Tanishq has uses future contract to hedge its purchase of gold for 1 year. It will not buy gold at current market price or spot price to make jewelry. So in June 2020, there could be two probability. Probability number one, if the gold price increases more than the lock-in price or hedge price, that is, here it is 48,000 rupees per 10 grams, this would increase the profit margin of Tanishq. Tanishq profit margin will increase after the effect of hedge have taken into account. Situation number 2. If the gold price has fallen down to 30,000 rupees per 10 grams, this would lead to the fall in the profit margin of Tanishq. The profit margin will go down after the effect of hedge. So it is important to note here is that in extreme conditions, Tanishq profit margin could become negative as a result of hedging carried out. Whereas PC Jeweler does not hedge its position to purchase gold for 1 year. It would buy gold at current market price or spot price to make jewelry. Now suppose if there is rise in the price of gold, that means it will be costly for the PC jeweler to buy gold. No doubt, the wholesale price of gold jewelry would increase due to increase in economic pressure, but the profit margin of PC jeweler would remain unaffected. On the other hand, if the price of a gold goes down, that means it would be less costly to buy gold for PC jeweler, but at the same time, the wholesale price of gold jewelry has also fallen down. So the gross profit margin of PC jeweler would again remain unaffected. Lastly, we will see the danger in hedging when the competitors do not hedge. When there is a change in the gold price, it would lead to change in the price of gold jewelry. What would be the impact on the profit of PC jeweler and the profit of Tanishq? So we have seen that if there is increase in the price of a gold, it would going to increase the price of gold jewelry, but it would have no impact or no effect on the profit of PC jeweler, whereas it would increase the profit of Tanishq. On the other hand, if there is decrease in the gold price, it would lead to decrease in the price of gold jewelry, but it would have no effect on the profit of PC jeweler, but it is going to reduce the profit of Tanishq. So that means a company that does not hedge considers its profit margin to be roughly constant, whereas company that does hedging can expect the profit margin to fluctuate. So findings from the present study shows that hedging can lead to both worst or best outcome as well. Hedging decisions is perfectly logical if you see in a big picture in the long run. So look at a big picture while hedging. It is important to realize that hedging using future contract can result in either a decrease or an increase in company's profit relative to the position it would be in with no hedging. All the implications of price change on company's profitability should be taken into account in the design of a hedging to protect against the price change. So therefore, the purpose of future contract is to hedge companies' exposure to price fluctuation, not to make profit. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.